Open YouTube right now, and you'll see people predicting gold is heading to 3 lakh, 4 lakh, even 5 lakh rupees. With Diwali and Dhanteras just days away, that creates a serious trap for retail buyers. You're caught between the anxiety of missing out on massive gains and the absolute dread of locking up cash right at the all-time high. You might read a headline about global gold prices dropping and assume a massive local discount is coming. But sitting on cash and hoping for a magical festive crash is a deeply flawed way to manage your money. Safely navigating this market means tuning out the sensational price targets. You have to understand the actual mechanics driving the cost of the metal, so you can choose a financial strategy that mathematically works. Indian gold has two engines. First, the global dollar price, which recently dropped 18%. But you didn't see that drop. Why? The second engine, the rupee, depreciated. This invisible buffer artificially props up the local price, eating up the global discount entirely. This explains the deep frustration of walking into a local jeweler. You read about a massive global crash in the morning paper, but the price quoted at the counter feels just as expensive as last month. Because the rupee consistently insulates local prices from global drops, waiting for a massive 20 or 30% discount in India is a losing bet. Look at this grocery sign. It represents the sticky consumer inflation in the US, and it's a primary reason global gold prices aren't collapsing. When US inflation stays hot, the Federal Reserve refuses to cut interest rates. They may even keep rates elevated to cool the economy down. That decision directly targets gold. Gold doesn't pay a yield. If the Fed keeps rates high, big investors sell off their metal and buy government bonds because those bonds actually pay out monthly interest. But the Fed is trapped. Look at the top row of this debt clock. The US is now spending more just to pay the interest on its national debt than it spends on its entire defense budget. When the world's reserve currency is under that kind of mathematical strain, investors flood into alternative assets that governments cannot print. These forces, stubborn inflation, interest rate tug-of-wars, and massive sovereign debt, stack together. They create a structural floor under the price of gold, making a return to the cheap prices of the past practically impossible. Knowing the price is structurally high changes how you should deploy your capital. The single biggest mistake retail buyers make right now is panicking and throwing a large lump sum of cash into the market all at once. Look at the investors who jumped in blindly during the record highs this past January, purely out of fear. Because they put all their money in on a single day, 8 months later they are still holding negative returns. The second trap is treating festive jewelry as a primary asset. Buying a necklace for Diwali is a cultural expense, not an investment strategy. Here is the math. The second you buy physical jewelry, you pay a guaranteed 3% GST, plus steep making charges that you can never recover. You are starting your investment in the red. These heavy friction costs put you in an immediate deficit. You need the global gold market to make a massive, sustained leap upward just for you to break even on that purchase. If your goal is safety and wealth preservation, the optimal vehicle is an ETF or a gold mutual fund. By setting up a monthly systematic investment plan, you pay zero making charges and bypass the physical storage hassle. Investing small amounts every month averages out your purchase price. You stop stressing about timing the exact market peak or waiting for a dip, because the automation handles the volatility for you. If you have a higher risk appetite and want to actively play the short-term market, the vehicle changes entirely. Advanced traders use gold futures contracts, putting up a fraction of the total cost as margin. With futures, you aren't holding physical metal, you are trading price contracts. This means you can take a position whether you think the market is going to spike up or crash down. Ultimately, the daily spot price of gold matters less than the tool you use. Your financial success depends on whether you match your goal to an ETF for slow safety or a futures contract for leveraged returns. If you are still holding cash and waiting for prices to drop 30%, there is one final piece of data you need to consider. The people who actually control the money supply are currently buying. This vault shows what institutional hoarding looks like. In a single recent quarter, global central banks aggressively purchased a record-breaking 288 tons of gold. When sovereign nations are absorbing that much physical supply from the market, it creates sustained, massive demand. Retail investors trying to wait out these institutions for a deep discount will simply be left behind. Map your personal situation onto this risk matrix. If you want stability, you belong in the bottom left as the long-term hedger. Set up a monthly ETF SIP, cap it at 15% of your portfolio, and let it run. If you are buying a necklace for your family this Diwali, do it with clear eyes. You are a festive consumer. Accept the taxes and making charges as a sunk cultural expense, not a ticket to future wealth. And if you understand market mechanics and want to actively trade around upcoming Federal Reserve rate announcements, you belong in the top right. Use futures contracts, leverage your capital, but protect yourself with strict stop losses. Intelligent investing isn't about predicting an imaginary 5 lakh price target from a YouTube thumbnail. It's about matching the right financial vehicle to your personal risk tolerance, cutting through the hype, and executing the math.